In the age of information, ignorance is a choice. Donnie Miller. Even though I don't 100% agree with that quote, we'll get into that later. Hello everybody, it's Dome with the Dome here, where we teach you how to use your dome when it comes to faith, fitness, finances, food, family, friends, and fashion. Today I'm going to do my best to unpack everything that 2020 taught me when it comes to finances that I did not learn in high school or college. Two things before I begin. Firstly, I will do my best to keep this concise because I tend to be a concise person. But this is a large feat, so I'll probably provide a lot of resources down below for if you want to learn more information. And please do more information on this yourself. I think it's important for everybody to be financially literate and know what's going on in the world economically. Secondly is I'm not a financial advisor, I'm just a random guy on YouTube, and I am doing this for entertainment purposes. So if you want to be entertained, feel free to watch. I think you might learn something that you didn't know before. If you didn't, then hopefully that just means that you're on the right track. So without further ado, let's get on to point number one. If you don't get anything else from this video, please get this. Point number one is to invest. I cannot stress this enough. This will be one of the best ways to grow your wealth over your lifetime. Now, if you look at it, inflation is roughly about 2 to 3% on average every year. So the way that I think about it is that every year you are being taxed roughly 2 to 3%, right? And if your money is in the bank and not meeting that 2 to 3%, then that's how much you're losing. And with most banks being less than a percent on interest, most people are losing value of their money. This is why oftentimes people put their money into the S&P 500, where you can, on average, see 8 to 10%, sometimes 6 to 12%, just kind of depends on the year, returns, because that's a way for you to beat the inflation rate, thus increasing your wealth over time. So something that I did not know and still blows my mind to this day is that you can make money if the stock market goes up or down. I know, bear with me. You can make money if the stock market goes up or down. There are stocks that I saw after the fact because I was in my master's and doing my thesis and my internship and things like that. I wasn't seeing these things. I saw these things months later, but there were stocks that 10x'd when the markets were going down, and not stocks. There were ETFs that, went up 10x when the stock market was crashing in about a month, and there's ETFs that have jumped 10x since then. So some people, if they're amazing and perfect, could have 100x their money. Now, obviously, doing that with 100% accuracy is super hard, and a lot of different factors, but it helped me understand why people like, say, StockMo or Zip Trader on YouTube swing trade. It helped everything align, right? And seeing that made me think that's how people do this for a career. This is how they can do it. And when I found when I found ETFs like UVXY or SDOW or SPSX, it showed me like, oh, you can make money when the stock market is going down. That being said, right, the S&P 500, typically you get, say, 6 to 12% average a year return, right? And no hedge fund has been able to beat those returns for 10 years consecutively. They might beat it a year here, a year there, but 10 years, no hedge fund is ever able to do that, which is why most people just say, let's just put money in the S&P 500. But what I was struggling with and trying to understand is if right, that stock market is going to go up. Why not invest in an ETF that is the S&P 500 times 3? Like most cycles, right? Most debt cycles, like, are at least 8 years. So even if there's a correction of 10%, like, it'll still go up in the long run, and then you just sell it when it gets to a certain point, right? So, you know, there was the dot-com bubble of 2000, there was the 2008 crash, you know, like, but like, so typically it's like in cycles, right? 2021, 2020, and you can sell while still achieving those 3x gains instead of just the normal gains of the S&P 500. I know this is confusing, so I'm going to try to make an illustration so that way you fully understand this, because I think this is one of the most important things to do. It's risky, obviously. You have to look for validation. Zip Trader, StockMo, they talk about all this stuff. Other people, financial advisors, talk about this stuff. Talk with them. Get investors and professionals on your side. But if you fully understand this and grasp this, this can really help people out financially. And that's what I'm trying to do. I'm trying to spread the word and just tell people, look into this stuff because it's crazy. So without further ado, I'm going to give you an illustration. So firstly, I want to show you kind of the debt cycles that I've been talking about. So typically this entire span of time is roughly 75 to 100 years. And debt cycles, I said 8, sometimes they're 8, sometimes they're 5, sometimes they're 12. It just honestly depends. And they last that like less than typically a decade. Obviously right now we're in one that's a little bit longer, which is why people were talking about they're expecting us to have a pullback. All I'm trying to say, firstly, is that it's important to see it's important to look at these trends. It's important to see when there might be a pullback, because if you could pull out your money, you would actually end up being able to buy in again at these lower rates. Okay, so for the illustration, oftentimes when the stock market is going up, you have ups and downs, and ultimately, if you believe, say, in the S&P 500, which is a very reliable place to put your money, ultimately it will go up. So when the stock market might drop a little bit, you might just put more money in, it'll grow at a faster rate. So I'm trying to give an example here. So say maybe you put in $1,000 at this point, right? Maybe it's exactly 1,000, right? Then it goes up to $2,000, right? You're like, awesome, this is great, like, so excited, right? But there's a pullback, and the pullback is to like 1,500. You're like, I know it's gonna still go up, so I'm not too worried about it. So I'll just wait it out, and eventually it goes back up and continues to go on to who knows how high, right? So ultimately, what a lot of investors try to do in the stock market is they try to take this period of drop from 2,000 to 1,500 and then back to the return of the 2,000. What they ultimately try to do is they try to turn this into only being gains in the stock market, right? So they just try to turn it upward and have it continue to go up, right? So that's oftentimes what a lot of day traders, a lot of investors who swing trade try to do, right? So I tried to map out an example of the above case, right? Because I want you all to see what what helped me understand this topic more, right? So I understand sometimes what people will do at this point is when it goes up to 2,000, if there's a pullback, they'll put more money in, right? I understand that, and I want to try to talk about if you don't put any more money in for either of the scenarios that I'm talking about, right? So bear with me on that and try to follow along. So some people, like I was saying, think the S&P 500, which it is a good steady place to put your money for growth, right? Over time, compounding interest, it will continue to go up, continue to increase. And I'm like, oh yeah, for sure. Some people know that there are ETFs which kind of trade like stocks, which are based off of the S&P 500, but they might be 3 times the amount of gains and losses in the stock market, right? So they're called SPXS and SPXL. So sometimes people will try to invest in those, that way they get 3 times as many gains, right? So back in last March, when the stock market tanked, right, SPXL dropped like roughly 5 times its value, but SPXS more than 3x its value, right? And then during the recovery, when the stock market was going back up, SPXL 5x'd and recovered what it had lost, right? So some people will buy in at certain points and they will get those like returns, right? So even if you may not have gotten the 3x or the 5x returns that some people might have done if they like executed flawlessly, sometimes what people will do is there might be a small pullback and they were expecting one, so then they sell, buy in on the opposite ETF or the opposite quote unquote stock, and then ride it out while the stock market's crashing. It will be going up, and then they trade it again to put it in the opposite inverse, like the inverse of that, and then ride that out. So even if you don't see the 3 to 5x returns, you might see 2x, right? So I tried to have 2 illustrations down here. One is if you just held it, you held the stock, it would be a long-term capital gains. So this is if you're in the tax bracket, pretty much making over $400,000, like significantly, like you're like in the 1% of US earners. I know by default, most of the 1%ers are not going to probably be watching this video, but I want to illustrate it with it because I think the numbers are easy to do, right? So first we talked about it, you having $1,000 that you put into the stock market, right? Let's say it dropped down to 200 or to 2,000, or it goes up to 2,000, I'm sorry, then drops down to 1,500, then goes back to 2,000, right? If you decided to sell when it got back to 2,000, there'd be a difference here of $1,000. So if you paid a 20% tax, what would ultimately you would do is you would multiply this $1,000 of gain times 0.8, because you get to keep 80%, which is just 1 minus 0.2. So you ultimately get to keep 80% of what you make, which will result in an $800 gain, right? Long-term gain, awesome, right? You got $800 more than the 1,000, right? Now, what I've learned is some people, they do more day trading or swing trading, not even necessarily day trading, because this process can take anywhere from a month to 4 months to 6 months or longer, right? So they're watching that. It just depends on the cycles, right? But let's say, from, like I said before, from 1,000 to 2,000, you had doubled your money, right? There are stocks that, or ETFs that the most I've seen is 13x either way down. 13x if it's going all the way, like as stock markets are crashing, it's going up 13x, and as it's going up, it is gaining 13x. But let's just say, only doubling your money, right? So you doubled it here to 2,000, then you swap that and put it into another stock or ETF. Sorry, I keep saying stock because it trades like one, and I feel like it can get confusing for some people. Let's say that then from 2,000 to 4,000, you double your money again. And then from 4,000 to 8,000, you double your money again, right? So the short-term capital gains, you will gain $1,000 because that's the difference between here. Then the difference between 2,000 and 4,000 is 2,000. The difference between 4,000 and 8,000 is 4,000, right? So because it's a short-term capital gains, you're being taxed twice as much, right? And some people would say, well, if I'm going to be taxed twice as much, I'm not going to do that, right? But let's look at the difference. If you have a 40% tax, that means you're going to get to keep 60% of what you made, right? So 60% of 1,000 is 600. 60% of 2,000 is 1,200. And 60% of 4,000 is 2,400. So that plus the original $1,000 results in you having $5,200 total. And as you can see, that is almost 3 times, because 3 times is 5,400. So that's almost 3 times what you would have if you just buy and held it out, right? Which is why a lot of people will swing trade, right? So let's go to 3 different options, right? There's obviously more. You can mix and match these. I understand all of them. Some people will just put their money in the S&P 500, goes up, 6 to 12% on average per year. It makes sense, right? Eventually, if you keep adding more and more money, it'll go up and go up and go up, right? Slow and steady wins the race, right? That's one way to go about it, right? Now, some people think, and some people trust the S&P 500, right? So there's a bear, which means when the stock market is going down, it actually is going up for the bear, right? And there's a bull. So when the stock market's going up, it's getting 3 times the gains, right? So if the stock market's going up, say maybe this route, it's going up that route pretty much. It's like 3xing the gains that you are going to be getting, right? So as I was saying, these markets grew over 2 times. So even if you got in a little late, you could still be making roughly 2 times the amount of returns, right? So I know some people might go like this route. That's what channels like Zip Trader and channels like StockMo might do. And then I know other people down here in option 3 where they might put most of their money in the S&P 500 because they trust it. It's not as volatile and things like that. But they might only put 10% into a bear ETF, which it goes up as stock market's going down, because there's ones that can go up roughly 3 times or 13x, right? So if you figure, say the stock market drops, even if it drops 50%, right? If it goes from 2,000 to 1,000, right? Actually, let's use a different example. Let's say you have $1,000 and you only put $100 in this bear ETF, right? When you're running into the end of a cycle, it's starting to you're getting a little nervous. You're like, we haven't had a correction in a while. It hasn't pulled back. So you have $100 in this bear ETF, right? That 10% that we talked about right here. And you have 90% or $900 in the S&P 500, right? So if this corrects, it's going to eventually go back to where it was. So let's say it corrects, goes to 600, and then goes back to 900, right? But during that same time, this $100 jumps to $1,000 because it goes up a significant amount. Then all you do is you just transfer that $1,000 to the S&P 500. So ultimately, when it goes back to 900, it's actually here. And then instead of it going just the normal 300 back up, it might jump even more and jump to say 2,000. So ultimately, they're just continuing to funnel that money back into the market to see more kinds of gains. And lastly, like I said, you can kind of combine or mix and match any of these. So some people might only want to do the bull, and they might want to the bull of the S&P 500, ride the wave up, sell out, wait to buy back in at a lower rate. Some people might only want to do the bear so they know when a crash is coming, so they might buy in, get out, and then put their money in other stocks or ETFs as well. So I put option 4 because it's kind of like a mix and match. Some people do whatever they think is good for them, and ultimately that's why you do your own research. I just thought this was so fascinating because I started to understand why swing traders and how traders made their money. So hope this was helpful. Now let's get into all the rest of the points. Point number 2, resources and self-sufficiency will be much more important than money when things get crazy. If you don't recall, back in March when there was those toilet paper runs, we saw that people were freaking out and going and running towards that. And I think what people forgot to realize was that money used to just be goods, right? So back in the day, I might have a bunch of rice, you might have a bunch of beans. I should be able to give you some rice in exchange for some beans. But at one point we decided that money was, you know, an adequate source of value, right? Or in other words, it was worth a certain amount of rice and beans. Additionally, we saw that people were stocking up on canned food items. With the canned food and the toilet paper runs, it really just showed me that resources are going to be king. Point number 3. Now this part really blew my mind. Only 8% of all currency in the world is physical. And in the US, only 11% of all currency is physical cash. So if I'm being generous and say 2% of cash is physical cash is in the hands of Americans, ATMs, places that give out cash like grocery stores, things like that, it would only take 10% of Americans wanting their money at the same time for there to be a bank run. However, during the craziness of last March, the Federal Reserve, wow. However, during the craziness of last March, the Federal Reserve passed a policy where they technically are allowing banks to have $0 in their vaults or zero reserves in their banks. Now, obviously, banks don't get to zero because, they have ATMs outside the bank, they make different transactions. But technically, banks are allowed to have zero reserve since last March. Now, this blew my mind because technically by this, it would only take 1% of Americans wanting their money all at once to cause a bank run. So because of this, some people like to have 1 month of cash for groceries and gas in case something were to happen like this. That way they can pay for the necessities. So I know I kind of went on a little bit, and some people are just like, what the heck is a bank run? So in short, a bank run is when multiple people all want their money from the bank at the same time. Sometimes this happens because people lose trust in the banking system. Sometimes it happens because people want diversification, some silver here, some Bitcoin there, so have some stocks. So sometimes they want diversification. Sometimes they hear that the banking system has negative interest rates. They're like, oh, heck no, you ain't taking my money. Even though with inflation, the banks, if they don't have an interest rate that meets inflation, you're technically losing some of your money anyway. So there's multiple different things that can cause a bank run. And additionally, the most notable bank run in US history was the one during the Great Depression, 1929 to 1932. However, the thing that I found very interesting was that there were already 2 bank runs last year in China and in Turkey. So, it's not like it's an uncommon occurrence in today's society. Now, though there is FDIC insurance, you're going to be covered. If something is to happen, you will be covered for these different expenses. However, it's important to understand how this really works So I'll leave some videos below so that way you can learn more about this. But in short, what will end up happening is money will be printed in order to cover the money that was quote unquote lost. So you will be covered from that. But because of that printing of money, eventually that will come in increased taxes. So you'll make money, put it in a bank. If something happens like a bank run, they'll print money so that way you're covered, but then you have to pay taxes because more money was printed to cover your expenses, thus devaluing the currency that is already being devalued as we speak. So it's kind of like a web, but that's it in short. So typically before a currency is devalued, there is a bank run, which is associated with debt problems, oftentimes from war. And because of these debt problems, there is more money printed. And then following this, there is typically the rise of a new reserve currency or new world power. Now, I'm not saying that this will happen, but I think it's important to know. If you stay in tune with a lot of the news around the world, you have China saying prepare for war and preparing for that. And if you look at Ray Dalio's book, you see that it looks like the new power coming or rising or on the rise is China. It wouldn't surprise me if they surpass us. So it's important to know about all these different things. That way, nothing's catching you off guard, even though, you know, it's the world. Like a lot of things catch us off guard. But it's important to be aware of these different things. So that way you can best plan and move strategically and plan accordingly. Number 4, we are currently at the beginning of a Great Depression like we haven't really seen since 1929 to 1932. If we didn't print as much money as we did last year, we would have really felt the effects of the economic collapse. It's only because of that printing that we're hanging on. Our economy is hanging on by a thread. In fact, I don't know if you know this, but after the Great Depression, it took the stock market 25 to 30 years to recover to the levels it was at right before the Great Depression, right? And Ray Dalio, the largest hedge fund owner, he thinks that we could be in that he thinks that we could experience a lost decade, which is kind of like that, where we do not see the highs that we're seeing now for another decade. He doesn't know when it's going to crash, but he's expecting there to be a crash, along with Cathie Wood and one of the best investors of our time in the next year. They both have said that they expect about an 80% drop, or would not be surprised by an 80% drop, which is kind of crazy to think, to even think about or fathom. It's possibly because of this that we saw so many CEOs leave, right? Like if you know that the economy is going to collapse, or you see this coming, you see the writing on the wall, they would be able to leave, sell their shares of their company and get out before everything kind of started to crumble. Now, this makes me think of another time in history, and that's 1865. If you read Ray Dalio's book, he talks about uprising, talks about violence as currencies shift, world power shifts, and if the stock market crash is big enough, right? And the reason why it makes me think of 1865 is this is when, you know, slavery ended, right? But what happened was there was the, you know, starting of the criminal justice system as we know it, right? So you're freeing a bunch of people who don't have really anywhere to go, way to provide for themselves. So to provide for their families, oftentimes they might steal, try to get food, clothes, you know, things like that. And then ultimately they ended up in jail. So regardless on your thoughts on if the police need to be defunded, if there needs to be reform in the police system. I don't want to get caught up on that. But what I do see is that the areas where defunding has taken place, the crime rates are at levels not seen since 2008. So why am I telling you all of this, right? I'm telling you this because right now, if there's decreased policing, right? If there's a lot of people hurting and people are saying that markets could crash even more, whether it's another spike in, whether it's, something else going on, the sniffle gets worse. Maybe the stock market does pull back. If any combination of these things pop off, that could really create a storm that could lead to this increased violence, these increased riots that haven't been seen since the Great Depression. And with talks of a potential war in China, who knows what could really happen this coming year. Point number 5, cryptocurrency will be the future. Now, obviously you have Bitcoin, Ethereum, which seem to be the two largest and safest at the current moment. And you have things like XRP, which tanked a lot if you were invested in that. So obviously I think you should do your own research when it comes to this. But if people are trying to say that cryptocurrency isn't the future, my argument for it is, why is there being such why there's such mass adoption? You have huge companies like PayPal, like Grayscale, like Chase Bank, who are investing in cryptocurrencies. And when you have this big money coming in, it shows that they're finding value in it as well, or they're finding less value in something else. And with Bitcoin, from the start of 2020 to the end of 2020, 4xing, going from 7,000 to, was it 29, going to around 29,000 and trading above that right now, it makes me think that I wouldn't be surprised if the next reserve currency was a cryptocurrency, especially considering that when they were first doing the bills for the stimulus checks, there was talks of them doing a digital currency in distributing it before it was eventually taken off. So makes you wonder, when will cryptocurrency be the next thing, instead of saying cryptocurrency may or won't be the next thing. Point number 6 is that there is no such thing as free money. We are only borrowing from our future selves with these different stimulus checks. And people are talking about Biden's new Biden's new tax plan, but people didn't realize that no matter whether Trump stayed in office or if Biden is in office, that taxes are going to increase. You look at this is already happening in places like California, Chicago, and you have people who are leaving places like in these big cities, such as California, like Graham Stephan, and you have people leaving these areas to avoid paying hundreds of thousands of dollars in taxes. You also have people, besides leaving those places, you have them kind of migrating towards Texas or Puerto Rico. So you have to really think, they see the writing on the walls, they see these taxes coming, and I don't think it's going to be too long before the taxes in these bigger areas migrates to taxes in smaller areas or less densely populated areas as well. Point number 7 really kind of shook me up a little bit, but there are ways to avoid paying taxes legally. And this still kind of is crazy to me, but people like Donald Trump, Robert Kiyosaki, who is the author of Rich Dad, Poor Dad, avoid paying taxes legally. Even companies such as like McDonald's, they end up buying real estate, and it's a way for them to legally not pay taxes. But that's way too much to dive into. So I'm going to link a video below if you are more interested. Point number 8, if you don't move some of your wealth to the stock market, you could actually be losing money. However, if you move your money to the stock market, you could lose all of your money. So what do I mean by that? There's a thing called a K-shaped recovery. You might have heard of it, you might not. The premise is there's two different ways to see it. There's businesses like EV, electrical vehicles, tech, or e-commerce, your Amazons, your Teslas that are doing really well and have been really growing during this time. Then you have companies like hospitality, transportation that have been doing much worse. Additionally, when it ties into individuals, roughly 52% of Americans are invested into the stock market. So if these individuals were picking the right stocks or right companies, then their wealth was growing during this time after the recovery from March, versus 48% of Americans, right, were not. If they were not invested, then they weren't being able to be a part of these opportunity of quote unquote gains. So additionally, if these individuals were some of the individuals that were affected by the significant amount of job losses in America, what could happen is these individuals were struggling so much more than individuals who, even if they lost a job, they still had some investments that were growing. So you're starting to see this K-shaped recovery, which is slowly separating people who are rich and people who are poor. And if I'm not mistaken, billionaires the billionaires of the world during the past year have actually gained $1 trillion, which is crazy to think about. Point number 9. If interest rates go to 0, the bank actually takes money from your savings account. And I know what you're thinking. Is this even legal? Like, that seems messed up. I thought the same thing, but it's already happened this year in some other countries. And I just want people to be aware, because oftentimes when this starts to happen, it can be linked to, tied to, or even cause a bank run. And no one wants that. So stay informed. So point number 10 is, what are the different options? I see 3 different possibilities. One is debt defaulting or economic restructuring based off Agenda 2030. I could see that happening eventually. Number 2 is inflation. That could cause an economic depression. No one wants that. Or number 3, hyperinflation, like in Venezuela, which is even worse and could cause a lot of hurt. I could see any of these things happening, but based off all the, must have been my Chinese. So the way I see it, I personally think hyperinflation would probably happen in the next maybe 15 months, but I wouldn't really know what that would look like until probably the end of March, just based off of some other trends. That being said, no one obviously wants any of this, but if we continue to print money, I don't see how cash will eventually become worthless, and who knows where we would go from there. The only way I can see it going is hyperinflation. Some might argue you could also see deflation and inflation. That's a whole different story, whole different topic, but feel free to look that up yourselves. I think that's really good to be diving into all the different possibilities. So back to the original quote. If you are constantly on the hamster wheel of life, right? You're working 40 hours, have a family, you're working 50, 60 hours, even if you don't have a family, come home, are tired, need to eat, need to sleep so that way you can function, do things with friends, family, to have a social life and have good mental health. What, do you have an extra hour a day? You have to think about the hierarchy of needs, right? So you have, food, you need shelter, you need clothes, right? If you're focusing almost always on that all of your life, how will you even get to the point where you can think about, oh wait, how do I use this money to grow, or how's this money make me money, right? You never even get to that point. And on top of that, what about the barrier to entry? It could be 30 hours if you want to learn things about things such as cryptocurrency, entrepreneurship, the stock market. Those could be 30 hours each. And that's if you know where to look, right? If you don't know where to even look, then it could be even more trying to sift through all the knowledge, all the garbage, and you have to really kind of create a funnel. When I was doing my master's in dietetics, I really, for my thesis, had to kind of comb through a lot of research to get to the good stuff. And I think that skill has helped me to be able to narrow and learn and feed through and comb through all of the information out there on the web to really be able to get to the meat and potatoes, to get to the really core truths and the things that work, and feed through some of the people or content that might not be as accurate or might just be a lot of fluff, especially as a concise person. So I want you to be thinking about how, if you are on the hamster wheel of life, how can you get off of it? Not saying you need to stop working, but how can you free up time in your day to be able to learn and educate yourself so that way you can be as financially literate as possible? Whether or not that means you need to live with a roommate or 5 to really cut down on your costs. Maybe you need to unsubscribe from Netflix. Maybe that might cut down on an hour of your day. Maybe you need to watch less YouTube. The possibilities are endless, but I really want you to be brainstorming and thinking about that so that way you can continue to learn each and every day. That being said, more millionaires were made during the Great Depression than any other time in US history. So when times are getting hard, when times are getting desperate, I want you all to be thinking, innovating, thinking, how can I solve a problem? How can I provide value? What are the needs of this community, of my state, my city? Because I could really help you as well as others for the future. So thanks so much for sticking with me on all that. I know it's a lot of information. If you got any value, you like the content, I made you laugh, please feel free and hit the like button. If you want to see more content like this, hit the subscribe button, and bendiciones. Take care. Wealth is how many months you can go without a paycheck, whereas being rich is just how much money you're making. Robert Kiyosaki.